Algorithmic trading has revolutionized the way traders and investors operate in the financial markets. But what really makes a good algorithm? Is it the complex code or the performance numbers? Performance is what counts. And in this fast-paced world of finance, knowing the right metrics can mean the difference between a winning strategy and a losing one. Welcome back to the channel. Today we'll be discussing the 7 key metrics to measure the performance of an algorithm. These are the benchmarks that separate top-performing algorithms from the rest. Whether you're a seasoned trader or just starting out, this knowledge is essential. So stay tuned and let's dive into the world of algorithmic trading. First up, we have the win rate. The win rate is a simple yet effective metric to start with. It's calculated by dividing the number of winning trades by the total number of trades and multiplying by 100 to get a percentage. A high win rate typically indicates that the algorithm is accurately identifying profitable trading opportunities. However, it's important to note that the win rate should not be considered in isolation. A high win rate doesn't automatically translate to profitability. To truly understand the effectiveness of a trading algorithm, it's crucial to look at other performance metrics in conjunction with the win rate. Next up is the risk-to-reward ratio. The risk-to-reward ratio is a critical metric in algorithmic trading that measures the potential reward of a trade against the amount of risk typically measured as the loss on a trade. It's a simple calculation, dividing the average profit per winning trade by the average loss per losing trade. A positive risk-to-reward ratio indicates that the potential profit is greater than the potential loss, suggesting that the algorithm is making sound trading decisions. In the world of algorithmic trading, a favorable risk-to-reward ratio is generally considered to be 1-to-1 or higher. This means that for every dollar risked on a trade, the algorithm should aim to make at least $1 in profit. Moving on, let's discuss the max drawdown. The max drawdown is the largest peak-to-valley drop from a trading algorithm's running balance. It essentially shows the maximum amount of money that could have been lost on a trade or a series of trades before a new peak is reached. In simple terms, it's the worst-case scenario of how much money could be lost when using the algorithm. Calculating the max drawdown involves finding the highest point in the equity curve and then determining the largest drop from that point until another peak is hit. A lower max drawdown is generally better because it indicates that the algorithm is better at managing risks and avoiding large losses. This metric is particularly important for long-term investors who want to ensure that their portfolios can withstand market volatility without suffering catastrophic losses. Now let's talk about the Sharpe ratio. The Sharpe ratio is a widely used metric in the world of finance that measures the return of an investment or trading algorithm per unit of risk taken. It is calculated by subtracting the risk-free return from the realized return of an investment and dividing it by the standard deviation of the returns. The standard deviation is used to measure the volatility or risk of the investment. A higher Sharpe ratio indicates a better risk-adjusted return, meaning that the investment has generated higher returns relative to the amount of risk taken. In algorithmic trading, the Sharpe ratio is a popular metric for comparing the performance of different algorithms and for evaluating the overall effectiveness of a trading strategy. Next, let's explore the profit factor. The profit factor is a crucial metric in algorithmic trading that measures the ratio of cumulative profits to the initial investment over a specific period. It is calculated by dividing the current asset value in the trading account by the initial asset value. A profit factor of 1 indicates that the algorithm has broken even, while a profit factor greater than 1 indicates that the algorithm has made a profit. In the world of algorithmic trading, a profit factor of 2 or more is generally considered to be a good benchmark for a profitable strategy. A higher profit factor suggests that the algorithm is generating consistent returns and is able to handle market fluctuations effectively. The profit factor is often used by traders and investors to evaluate the overall performance of an algorithm and to compare it to other trading strategies. Another important metric to consider is the return on investment, or ROI. ROI is a common metric used to measure the profitability of an investment or trading strategy. It is calculated by dividing the net profit or loss by the initial investment and multiplying by 100 to get a percentage. A positive ROI indicates that the investment has generated a profit, while a negative ROI indicates a loss. In algorithmic trading, The ROI is an important metric for evaluating the performance of different algorithms and for comparing them to other investment options. A higher ROI suggests that the algorithm is generating strong returns on investment and is able to generate profits consistently. Now, let's discuss the annualized return. Annualized return is a metric used to calculate the annual rate of return for an investment or trading strategy over a specific period. It is calculated by compounding the periodic return at regular intervals, usually monthly or quarterly, and then multiplying it by the number of periods in a year. The annualized return is expressed as a percentage and is used to compare the performance of different trading algorithms over varying time periods. In algorithmic trading, annualized return is an important metric for evaluating the long-term profitability of a trading strategy and for comparing it to other investment options. A higher annualized return suggests that the algorithm is generating strong and sustainable returns and has the potential to grow wealth over time. Many algorithmic trading systems incorporate high watermark metrics to ensure transparency and alignment of interest between the service provider and the investor. Performance fees are only charged when the trading account grows by a predefined percentage beyond its previous peak or high watermark. This means that the service provider will only receive a fee if they deliver a positive return to the investor. The high watermark approach ensures that the service provider is incentivized to generate sustainable long-term growth rather than focusing on short-term profits. When using a managed account service like those offered by Faida Ventures Limited, it is essential to consider the execution speed and slippage rates of the trading algorithm. Execution speed refers to the time it takes for an order to be executed after being sent to the market. Slippage, on the other hand, refers to the difference between the expected price of a trade and the actual price at which it is executed. In fast-moving markets, where even milliseconds can make a significant difference in profitability, it is crucial to have an algorithm that can execute trades quickly and efficiently. Automated trading systems are designed to address these challenges. They use advanced technologies and infrastructure to process and execute orders almost instantaneously, minimizing slippage and ensuring that trades are executed at optimal prices. In conclusion, the performance of an algorithmic trading system can be gauged by a variety of metrics and benchmarks, each offering a unique perspective on the system's effectiveness and efficiency. From basic measures like the win rate and risk-reward ratio to more advanced metrics such as the Sharpe ratio and profit factor, each metric provides valuable insights into the system's strengths and weaknesses. By regularly reviewing these metrics, investors can gain a comprehensive understanding of how their algorithmic trading system is performing and make necessary adjustments to optimize its performance over time. At Faida Ventures Ltd., we leverage cutting-edge technology and years of expertise in the financial markets to develop advanced algorithmic trading systems that can adapt to changing market conditions and provide our investors with the best possible returns. We believe in transparency and keeping our clients informed every step of the way. That's why we provide regular updates on key performance metrics so you can track the progress of your investment. Our team of experienced traders and analysts continuously monitors and tunes our algorithms to ensure that they remain effective and efficient. We are committed to staying at the forefront of the industry and incorporating the latest advancements in technology and trading strategies. 2. Provide our investors with the best possible returns. Thank you for joining us today. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more insightful content. If you have any questions or comments, feel free to drop them below. We'd love to hear from you. Stay tuned for our next video and let's continue to grow together. Until then, take care and happy trading. Disclaimer: the content provided in this article is for educational purposes only and is not intended as professional financial advice. Faida Ventures Ltd. is not a regulated entity. Please conduct your own research and consult with a professional financial advisor before making any investment decisions.